Welcome everyone. There's going to be 4 sections to this video. The first one's going to look at the margin requirement for a position. We're going to start off with the $10,000 account and go through the calculations for that. Then we're going to move into when the stock moves, how does it affect the option, and then how does that affect our margin requirement, which of course is going to affect the account and the size of the account that we may want to have. Then we're going to look at the margin requirement when the stock is assigned. Then finally, we'll determine the size of an account for one contract based on what we're trading here and the amount of cash cushion that account should have as well. So we're going to start this off with a $10,000 account. And I am just doing everything in Google Sheets. And we're going to create a few formulas to do our calculations. So the first thing we're going to do, we're going to look at Microsoft. We're going to look at the 220 strike. That's going to be on January 13th. And let's just go take a look and see what the option chain looks like. So here we have January 13th here. And we can see we've got 86 and 90. And we can pick a midpoint of about 86 or 88 is what we'd actually execute at if we sell the put on this strike. So we'll just go ahead and make this conservative and choose 86. We'll note the price is $239.91. So we're going to go back to our spreadsheet. And we have a price of $290.91. And we also have our premium that we're going to use of 86. Strike price. And we're going to put this over here. That way we can better access it whenever we're putting together our calculations. So there are 3 different formulas that we're going to utilize in determining the price of our option and our margin requirement. And those are going to be coming from Tasty Trades. So we're going to go and take a look, see if we can find that. Let's just do Tasty Trade, and it's going to be option pricing. And let's take a look. Let's see, I'm going to do naked short put. And this is the one that we want, naked short put margin requirement. Click on this. Okay, so here are the 3 different formulas that are used to calculate. And what you do is take the highest of the 3. Down here they have some examples. So we're going to take what they've given us here. We're actually going to plug that in and build these formulas up in the spreadsheet. So if we go back to our spreadsheet, I'm going to start creating a formula for this. So for the first formula, we're going to take our price, and actually what I'm going to do is just copy this and paste it in here. Actually, let's try to put that inside my formula. There we go. Going to create a few parentheses to contain the different parts of this. So we're going to do our C2, which is the underlying price times 0.2 minus. We're going to go back with C2, get the difference with the strike, which is going to be B3. I'm going to put that in parentheses. And then we're going to add the premium, which is C3, and we want to multiply all of that by 100. So the order of operations here are important. You'll notice that this right here is all contained inside of a parenthesis. So that way, whenever we're adding things and then we're doing this final multiplication, we're multiplying this entire package by 100. And that will give us a number. Let's go ahead and change this to dollars. And it looks like we do have a mistake here because I know this is not going to be quite that high. So let's go back and look and see. This is actually going to be a multiplication. And we want to subtract. And C2 minus B3 plus C3. And I think I know what the issue is. Go back to Thinkorswim. This is $239.91. There we go. All right, so that's our first one. Then the calculations get a little bit more simpler as we go through them. And so for the second one, we're going to go ahead and do 0.1. This is also going to be contained within parentheses, and that's going to be times our B3, which is going to be the strike, And we're going to add the premium, C3. And we'll close off the final parenthesis and we'll multiply that by 100. And then the last thing here is just going to be 250, which is that right there. And if you're building these up on your own, the examples down here are pretty helpful in how to do that. And so what you can do is take their numbers, put them into your formulas, and you should get the same values that they have here as you're going through and creating that. All right, so there we have our formulas. This is going to be the one that's going to be the marginal requirement on this one contract, the Microsoft 220. So now what we want to do is figure out the impact of the stock price movement on the margin requirement. So to do that, we're going to go out to another website, which is going to be optionseducation.org. And I am going to go ahead and open a new tab. I'll have the link to them as well in the bottom of this video. Let's see, I'm going to increase the size of this. All right. So we can go ahead and get Microsoft. This is end of day, so it should have the latest prices. If you're doing this intraday, you'll want to manually adjust the price because it's not going to have the latest. There'll be a bit of a delay. The implied volatility may also be off as well. And we're working with the 13 here. And let's go ahead and look at our implied volatility on this particular option, which is going to be 3682. We'll change this. The interest rate is probably fine. We can change that to 3.5 if we want. Do a calculation and change our strike. All right, so we have 97 cents for the put, which is a little higher than what we actually have in the options chain. And the call is 2101. Let's go look and see what the call actually is. So yeah, that's not bad. It's not too far off, a little bit, but not too far. It's manageable for what we want to do here. All right, so if we go back to our spreadsheet, we're going to take this and copy it and paste it down here. So we're going to do a change and see what happens. As the price of the stock comes down, gets closer to our strike, we know that our premium is going to spike. So let's go ahead and put another number in. Let's do 225. And we can see here we're jumping up to 4,000, but that doesn't give us the whole picture. We want to know what is going to happen to our option premium, which is where the options calculator will come in useful. So if this goes to 225, we can run another calculation. You can see quite a jump there. We're going to plug in 434 into our formulas, 434. And you can see we're almost up to 4,500. All right, so now we can see how the option coming down is affecting the margin requirement. And in fact, if this went below our strike, it would go up even more. So if we started off with $10,000 and we have a $3,500 option, what is that going to leave us on the balance? So our cash remaining in this account would be, at the beginning, 6,466. We can just say this is cash at time 0. Then if we go to some event in the future where this is actually going to drop quite a bit, and we'll take our 4,400, and we can see that we have basically half of our account available to us. So if this then dropped to, let's say, 220, all right, so that's going to go up, and now we need to adjust our option. 650. Let's see what the impact of that is going to be. So now we're just under half of our account remaining. So if we're going to trade one option of Microsoft, we might imply that we could potentially trade 2 of these contracts. But if we do, we run the risk of getting a margin call because we're about $50 short of covering that other contract. So in this case, one contract of Microsoft in a $10,000 account would leave room for volatility. So it would leave room for this option to move around and provide us enough cash cushion, and not a worst case scenario, but a pretty bad scenario, for example. Because if this went to 215, 210, our cash would deplete, but probably would go down to 4,500, maybe 4,000, but we'd still have plenty of cash. But we know it's not enough to add a second contract of the Microsoft 220 strike. So then the next question, what is going to happen upon option assignment? So as the stock drops, we'll go down to 220. Our option is spiking in premium, going all the way up to 650. So the option is going against us quicker than the stock is dropping. In fact, we can look at that. Let's go ahead and do a difference here. If we do 220 divided by 231, about 5% is what the difference is there. If we do the same thing here, so 86 divided by, subtract from 1. All right, so quite a difference in the change of these two here, because as we get closer to our strike, gamma kicks in quite considerably, and the loss in the stock may be a bit linear, but the loss that we could incur on our option can potentially get exponential, especially as we approach the strike of our option. So we certainly have to be aware of that. That's why having plenty of cash inside of the account is an important consideration. All right, so now we want to take into consideration what happens to the margin requirement upon stock assignment. So at 220, we could get a sign. Below 220, we know we are going to get a sign. So what we've done is we basically take in Microsoft, which is a quality stock. It's probably across the board on different brokers, going to have around a 20% margin requirement. And upon assignment, that's going to go up a little bit more, maybe 25%, maybe 30%. On some brokers, it may just stay at 20, which means there's not going to be any change in the margin requirement whenever you go from the option to the option assignment. So let's say we have 220 times 30%, 6,600. So with a $10,000 account, for sure, we could not trade two contracts if we just look at a 30% margin requirement and just consider the assignment is always the case, and we work off of that margin. We don't even have to worry about what the margin here is going to look like. The assignment is going to be more than the requirement here. So at the highest level, this was 550. And then you can see the assignment is a little bit more because, again, it's going to be a bigger requirement at 30%. And even if your broker's doing 25%, calculating this off of 30% is going to give you a good bit of buffer. So that if you're considering how many contracts to trade in your account, you automatically know you can only do one contract. Now, if you had a $15,000 account, potentially you could do two. So it'd be $13,200. And if you had a $15,000 account, that would leave a little bit more cash cushion in your account. And let's just see how much that is going to be. Divided by 15. I'm going to change that to 1%. So you have about 12% of your account remaining. Whether that's good or bad, that is going to be the subject that we're coming into next. All right, so now we've determined how to calculate the margin requirement. We want to see what is the cash cushion we need to allow volatility to move around inside of our account. All right, so here we have 12% on a $15,000 account, basing it off of a 30% margin requirement, and that also takes into account the assignment. Is 12% enough? Well, it is pretty close, I would say, and maybe you want to look at something a little bit more to give more room to move around. Although we've actually factored in this dropping to our strike, so maybe that is enough that we've factored into the movement of this. Now, if we start back off at the current price of 230, and that's all we're going off of, we're really not going to take into account how much movement this could potentially have. So we always want to kind of run the calculations to figure out how much movement this option may have. we know one assignment is going to be $6,600, and on a $10,000 account, we're done. That's the most we can do. So we look at our $15,000 account, and we're going straight line with 30%. We're not looking at the movement of the option because we've determined the assignment at 30% is going to be more than the movements that we're calculating here. So it's kind of giving us a worst case scenario with the 30% on the option assignment. And 12% would be cutting it close a little bit, I'd say. I would maybe want to do 20%, a little bit more, maybe 25%, just to see what's going to happen. And based on the volatility of Microsoft as well, that could be factored in. I wouldn't want to do this going into earnings, of course, because you never know what's going to happen there. 12% margin or 12% cash cushion in this account probably would not be enough if Microsoft has a bigger move. So hopefully you found this helpful, and just subscribe if you would like to get more updates on put options selling, and thank you for watching. To learn more about selling put options, please visit steadyoptionincome.com.